And we're on.
Perfect.
Testing. How is everyone today?
Doing really well.
Brian, do you hear us?
All right. Hello, guys. How are you, Carlos? How's everyone?
Hey, very good.
Good, mate.
All right, we have a full panel now, so I guess we can just get started. Hey, so welcome again to everyone from the Fringe community that joined, and also from the Lido community. We are here to discuss, our partnership and our most recent integration of Lido as a collateral asset on the Fringe Finance platform, and a couple more things. So stay tuned. We have here Justin from the marketing department at Lido. We have Brian, our CTO at Fringe Finance, and we have the Lido account, whoever is manning it. So would you like to give a quick introduction to what Lido or Lido is, Justin? What
Sure.
your role is?
Sure,
And
either of those
an official pronunciation, so we'll just keep rolling with it.
Either of those pronunciations are just fine with us. There is, to my knowledge, not a specific guideline for it. It really sort of depends on what your kind of first language is and how you'd pronounce that word phonetically. So many people call it Lido and many people call it Lido. But as far as an introduction to what Lido or Lido does, we are the largest liquid staking derivative protocol across all layer 1 chains, but obviously our kind of home has been the Ethereum ecosystem. We are also live on Solana, on Polygon, on formerly Terra, and we have a couple of other layer 1 platforms and layer 2 platforms that we'll be supporting in the near future. What a liquid staking derivative protocol is, well, if you want to participate in securing the layer 1 network that you feel closest to or participate in using your network tokens, that would be Ether, Solana, Matic, what have you, you can use a liquid staking provider like Lido to stake those tokens in the proof of stake system, experience the underlying rewards given to stakers without having to set up any of the technical infrastructure to do so. Additionally, with a liquid staking token, you get a receipt token back. In the case of Ethereum and Lido, you get the STETH token back, which can be used within many DeFi protocols and strategies to generate additional yield. You can LP with it. All kinds of really cool things that opens up a whole lot of optionality for a user beyond just holding naked ETH or Solana.
All right, cool. And Brian, since you're the expert and we have you here, and there's also like a lot of people from the Lido community that are joining this and that they might not have heard about Fringe. Would you like to just give a quick breakdown of what Fringe is and how we're collaborating with Lido?
Yeah, sure. Absolutely. So Fringe, in the essence, is a lending platform. It's a non-custodial lending platform. So it employs over-collateralized loans, and specifically it gives out stablecoin loans collateralized by long-tail assets. And that's really our sweet spot. I'll explain that a little bit. So our model is familiar and it's sound. So given it's non-custodial, it doesn't permit any of the trusted shenanigans of some of the other dumpster fires of late in the DeFi or, let's call it more generally in the crypto space. There are lending markets out there that service the more popular and larger cap tokens, but our difference is we support lending against these longer tail assets. So the smaller cap tokens. Our vision is to be the place to go for holders of long tail assets. And no one else in the industry really does this well or with our focus. We've got some special engineering and some lending parameter modeling that is tailored for long tail assets. And particularly today, we're talking about the LDO token. And we're in the business of giving additional utility to holders of those long tail assets. And that includes individuals and DAOs. So they're holding their assets because they're passionate about their project and they believe in the token's upside potential. So we believe in this because there's a lot of capital tied up in those assets, and holders do not want to part with their tokens, and they don't have many other options in the DeFi ecosystem to deploy their capital while they wait for their tokens upside. So we're offering Lido token holders the opportunity to deploy their capital and to take out stablecoin loans to fund either operations if you're a DAO, or any other activities that you wish to partake in the DeFi ecosystem. So that's in a nutshell. If there's any, that really sums up what fringe finance is about at the core.
Yeah, and I'd just like to add that Lido was one of the first assets that we integrated as a collateral asset for USDC loans on the Fringe platform. And it's just been great to see how Lido has embraced this. Like, the biggest loans so far taking place in our platform have all been against Lido. So yeah, I'd like to just say cheers, because like your community seems very active and very cool.
Thank you. Yeah, one of the nice things about our community in particular is that they often embrace new DeFi optionality wholeheartedly and very quickly. Many of the people that engage with Lido across chains are pretty advanced yield farmers, people with a level of comfort within DeFi. And so these types of partnerships are really important to us to make sure that our community is served with new options. And to my knowledge, Fringe is the first place that this type of optionality has been made possible. So I'm not surprised that we've had some success together already.
Yeah, that's great to hear. We, Justin, we're absolutely stoked to be able to talk to your community, because really that's what we're about. We engaging with the communities of the tokens that we list is absolutely key, because it is, where our reason for being is to deliver value for those token holders, and to get the opportunity to talk to the holders of these tokens is absolutely, it's, something we really enjoy doing. And it's great to hear, Lido and that whole ecosystem is a savvy community, by the very nature of what you guys are doing. And we think it's quite important that we partner with you guys, and it's all part of our long-term strategy to deliver this kind of capability for a whole host of tokens, so that we get the kind of volume on our platform that makes it really good for building deep liquidity in our capital pool. So it enables borrowers using Lido tokens to take out loans with less interest rate slippage that would otherwise appear in some permissionless lending pools that may one day or facilitate lending against Lido tokens. So we think we've got quite an edge there, and we offer a pretty good benefit for people who are interested.
Absolutely. Would you mind, for the listeners, just letting us know which other tokens are currently listed?
Carlos, do you have the list up there?
Yes, I do. Let me just quickly cover it. Although I want to say that our mission is to list as many assets as possible, and we're working on all kinds of creative ways to do so. So this list will and might change a lot in the future. But we just launched the platform last month. So we launched incorporating Chainlink, Ren, Bancor, IOTEX, Polygon, Origin, and Tomo Chain. And since that, we've also listed Shiba Inu, Lido, of course, ApeCoin, and most recently, the Shapeshift Fox token.
Cool.
So as you can see, like, this is a list of a couple of big assets coupled with other assets that do not have access to these kind of opportunities. And especially, well, it's funny because people take it against lending platforms when it comes to a lot of the troubles and volatility that DeFi has experienced lately. So this just like shows that there's a big opportunity for people to test out different models and also to continue to trust models that have reliably worked in the past. So you see that even though a lot of things have happened, models such as makers, compounds, etc., those all remain untouched. So I think that's just an opportunity for Brian to quickly touch on how Fringe borrows from these protocols and what are the lessons learned from all of this volatility.
Yeah, I'd love to
Sure.
hear a little bit about how Fringe is different from the kind of current set of leading money markets in both structure and approach.
Okay, well, I think there's differences and similarities, and I think they are both strengths. So first of all, I'll talk about the similarities. We do use a lot of engineering from Compound, which is tried and tested. So that is something that is proven to be very functional and worthwhile. So that is, well, we've seen those platforms and those models being quite successful. Over collateralized lending platforms have not suffered the kind of unfortunate circumstances that over leveraged platforms have of late. So we are really here to build good, solid engineered systems. And as I mentioned before, to avoid the kind of shenanigans that have occurred. Now, the difference, which I did touch on, is, of course, our intent is to be the place to be for long tail token holders. And so we've got various engineering in our platform that best facilitates that. And that includes, or I should mention some engineering plus also some lending parameter modeling. And that works hand in hand to ensure or best assure stability of our platform. And a little bit of detail behind that. The lending parameter modeling looks at both the loan to value ratios and determining what is optimal to deliver as much capital efficiency as possible, yet still maintaining stability of the platform. With a lot of these long tail assets, they have a different volatility profile to some of the larger assets. So it is only natural to ensure stability that we have different loan to value ratios. And our modeling tools pop out LVRs around 50%, 60%, depending on the token. Also, we have maximum borrowing capacities for each of the tokens. And what that protects against is two things, or two primary things. One is to ensure that there is sufficient liquidity in the trading venues for these tokens to ensure liquidators in the event of adverse market conditions are going to be ready to participate as liquidators on our platform, knowing that they can readily dispose of any assets that they win in liquidations. And those assets are the collateral assets that people use to collateralize loans. And another aspect of that is the maximum borrowing capacities also protect against price manipulation attacks, which is something that has plagued a number of lending platforms in the past. And we have special attention on that because of this particular nature of the tokens, these long tail assets that we list. So, Justin, that's a little bit of a description that they're the key things that we think are both the similarities between the existing platforms that give us strength because it's proven models and proven technology. We do, in fact, use some of the smart contract logic, and there are also some of the differences, the way we model and ensure that the lending parameters are configured appropriately to reflect the particular nature of the tokens that we list as collateral types.
Yeah, I'm glad to hear that you've taken that approach. You know, as we all kind of know, money markets are a particularly attractive target for exploits within DeFi. We see it month after month. And Lido is always very sensitive towards trying to integrate with and partner with money markets that have taken a security-focused approach so that we don't wind up in difficult situations.
Well, that's great. Yeah, you know, if your guys and wish to have further discussions about what's under the hood there, you know, we're really happy to jump on a call to talk further about that. But that probably, as you're gathering, is a particular area of interest for us because, you know, we're trying to be here for the long term. And so it's really about building technology which is solid and durable so that it scales over time.
Absolutely. And I think now that we've covered a little bit about the kind of specific approaches that you've taken towards building this, maybe we can talk a little bit about what's coming. You recently announced in your July wrap-up that the staking platform is coming rapidly to Fringe that would allow people who acquire Fringe tokens to participate in staking. Maybe we can talk a little bit about that.
Sure. Yeah, we have built a general purpose staking capability, our staking platform, and the whole intent there is to deliver a platform that allows us to appropriately incentivize participation in the Fringe ecosystem. And so that is far and above just staking our governance tokens so that people can receive a proportion of the fees collected by the platform. There are a whole host of other staking opportunities that we envisage here. And one of them will be rewards for liquidity provision, so that liquidity providers are willing to provide liquidity for not only our Fringe tokens, but even we can partner with our partners and offer incentives there. Also, we have a stablecoin platform in the works, and we're in testing for that at the moment, and we will provide the ability for the stablecoin holders to receive rewards on our staking platform also. And another thing will be our partner projects to allow them to have the opportunity of promoting their project. We will allow them to make contributions of tokens that will be distributed to, for example, Frin, our governance token, our Frin token holders, so that they get to learn and understand and have the opportunity to hold those tokens, so to receive those as rewards. They're some of the rewards programs, and once we also have our fixed interest capability to market, which we're in the process of also designing at the moment, that will allow the liquidity providers for the interest rate derivative markets to be incentivized also. So there's a whole host of things there that I think is quite crucial that we can deliver through our staking platform. And it's going to be quite exciting. And I think there are even staking opportunities that we have not yet envisaged that we can deliver through that.
Cool.
Yeah.
Thank you.
Hey, I wanted to introduce, well, we have Alex joining. Alex is part of our development team, as well as Brian Sasson. So yeah, happy to have you here, Alex.
Welcome.
Hello, everyone. Hello.
To everyone else
Alex.
that's requesting to speak, we'll have a Q&A section further down, I think in the last 20 or 15 minutes. So hold on for that, but you will be allowed to come to the stage. Sorry, Justin, you were saying?
Yeah, Alex, now that you've joined, as we've been having this conversation, is there anything that you felt has been left out or something that you think is important to highlight to our community?
Yeah, I mean, I think that just one benefit of the risk analysis that we carry out and the parameter calculations is that we can list collateral assets with like very good assurances that they are economically secure. And so there's no like risk that we're listing, small cap collateral assets, and that will result in the platform being drained because they're susceptible to potentially like price manipulation attacks or various other attacks. And so we basically ensure that every collateral asset we list, we can guarantee is not able to be attacked in those ways. And so that allows us to list them all within the same capital pools. And so that allows us to just have a single capital pool for each capital asset that is listed. And currently that is USDC. And so as a result, we don't have to fracture liquidity as lending platforms such as Rari do. And so I think that is like one of the most significant benefits of Fringe over other platforms that are permissionless lending platforms like Rari, insofar as that we are able to provide borrowers access to a single concentrated pool of lending and liquidity as opposed to multiple fractured pools, which allows them to be exposed to much less interest rate fluctuations and interest rate slippage than they would on other platforms. Yeah.
Yeah, that's a really good point.
Yeah, and I'm glad that you brought up Rari because I think that a lot of us in this space have been seeing what's happened recently with Rari and that's brought a little bit of trepidation to engaging in a money market like this. What do you all think? I mean, we've talked a little bit about what sets you all apart from Rari, but I think in many ways you've been building towards a much better version of that. Is that sort of part of the approach here?
I think a key difference is I think as Alex is emphasizing, we put a lot of focus on analyzing the risk profile, the particular risk profiles of any asset that is listed on the Fringe Finance platform. So they're whitelisted and they go through quite a bit of scrutiny. So that is a key difference to other platforms that you were mentioning there. It's in terms of listing, it's not as permissionless as some of the other platforms, but the intent there is to avoid the risks that arise from taking that other approach.
But yeah, I think like we definitely do aim to achieve at least the same goal that Rari aspired to, which is to allow for like longer tail assets to be lent and borrowed. We just think that we have a much more effective model that is much less susceptible to catastrophic risks as we believe Rari is, and also allows for much more concentrated liquidity. Yeah. Yes.
Got it.
Yes, and our marketing team is a bit concerned at the moment because we have, even at this stage, about 75 tokens at the ready that will be valid for listing. So they've got a lot of work to do to strike up partnerships and produce the right material to spread the word. And that 75 tokens is really just the beginning because we are looking at other ways to obtain reliable and trustworthy price feeds for a whole series of other tokens above and beyond that. And even though I'm talking about other tokens, it's not and us listing those, that really benefits anyone using this platform, or the way I see it, because Lido holders indirectly benefit from all of that because creating a greater ecosystem means that there's more capital which is drawn to the market and therefore more capital available for Lido token holders to borrow.
Great. Alex, may I ask you to mute yourself when you're not talking?
Oh, yep, sorry.
Thank you. But I really appreciate that. And on the subject of LDO, and I'm sorry if I'm putting you on the spot, but maybe you can tell us a little bit about, in your view, what the risk profile of the LDO token is. That might be really interesting.
Alex, I think you're best positioned to talk about this one.
Okay.
Yeah.
So, I mean, yeah, basically we carried out the same quantitative risk analysis on Lido as we did with all other collateral assets we listed. It's not so much qualitative. So we do carry out special analysis for tokens that are like, say, custodial, where for example, it's actually, if we were to list WBTC, we'll carry out analysis on that, like with regards to the risk factors associated with the custodial setup. But for LDO, given it's a governance token, we basically just looked at how expensive it would be to carry out a price manipulation attack on the price feed of Lido. We then analyzed the liquidity available on markets for that trade Lido, and we analyzed the historical volatility of Lido. And so we basically like looked at the worst case volatility that Lido's experienced over about a 2 to 4 hour period. And so that is the period that we expect to be sufficient for liquidations or to be necessary for liquidations to take place in a worst case scenario. So we basically want to give liquidators a certain amount of time to liquidate loans. And so we found that, let me just check the LVR. We basically found that the LVR of Lido would need to be, let me just check the exact number. We basically found it would need to be like whatever it currently is on the platform, which I don't have with me right now, in order to be resistant to that drawdown, the worst case drawdown. So basically, the current LVR that we've set Lido to use would mean that even if we repeated that worst case drawdown of Lido again, we will be completely fine and we'll still be over collateralized. And so therefore all loans will be able to be liquidated if necessary, safely without any funds being lost. And so, yeah, those are the three primary considerations we had when we were listing Lido and determining what safety factors and parameters to use. So to prevent price manipulation attacks, to ensure that liquidations can occur based on the liquidity in the markets, and ensuring that the volatility has not exceeded, ensuring that the LVR is set such that the worst case volatility would not cause our platform to become under collateralized.
Yeah, there's something that is worthwhile adding to that is, Justin, we continually monitor the lending profile or the risk profile of the tokens. So there is the opportunity for us to tailor and relax some of the constraints or parameters around the tokens to reflect, for example, increasing liquidity that becomes available for a given token over time. And what that means is, for example, with Lido, we've got a 50% loan to value ratio offering on the platform. So it's relatively, let's say, capital efficient. And again, as Alex mentioned, that reflects the nature of the token. And the maximum borrowing capacity at the moment is just over 600,000 USD. So we continue to run our parameter modeling against the tokens. And what we envisage is, as liquidity increases for Lido in the trading venues on which it's available, we see that borrowing capacity increasing over time. And some of the other tokens there, for example, like some of the ridiculously large ones like Shiba, we've got borrowing capacities of 35 million. So we will tailor the borrowing parameters or lending parameters to reflect the current state of the token.
Very cool. I only have one more topic that I wanted to cover for the benefit of the Lido ecosystem community. You also had kind of mentioned in the July wrap-up blog post that you are working towards layer 2 and Polygon expansion. Lido is currently in the process of enabling bridges, hopefully in the very near future, for wrap staked ETH to Arbitrum and Optimism. We're also currently live on Aztec, and you can get wrap staked ETH on ZK Sync via the Argent wallet, which is integrated with us. So that's, as a DAO, a place that we really feel a lot of economic activity is going to be moving towards, as it allows users to engage in all the same kind of DeFi actions with lower gas costs and hopefully better capital efficiency and trade execution efficiency. So I'd love to know a little bit about what your plans are there, and, you know, hint to the community that we'll probably be trying to work together on those destinations as well.
Yes. Okay. So there's so many moving parts on that one, but I'll start, and Alex may very well have some things to add to this. But we have two aspects of our multi-chain strategy. One is multi-chain, and the other is like a particular aspect of that, which is cross-chain. So multi-chain is making available our lending platforms on other L1s and L2s, and we will be able to provide lending capability against tokens that exist on those chains. And if you've got wrapped staked ETH, then theoretically we can provide lending capabilities on those other chains with all of the benefits that you mentioned, such as lower access and operational and gas fees. And of course, the liquidity, we'll look at each of the tokens available on each of these platforms and determine the lending parameters that we may need to establish for them. So it's, again, our standard process, which is, we just look at it in appropriate detail to determine what kind of lending we can offer across those chains. And of course, we look at the integrity of the bridge, because that's quite important, because the integrity of that bridge is quite crucial to the viability of a lending platform. So that's just a key aspect that we'll begin to look at more closely also, which is for tokens that aren't native to those other L1s and L2s. Ultimately, we're toying with the idea of cross-chain collateralization also, but there, as I mentioned, a few moving parts to that one, and it will be tricky to get the engineering right on that, but we're exploring that in detail at the moment. Alex, what else do you have to add to that that might fill in a bit more detail?
Well, yeah, I mean, I think that we definitely value the ability to use wrap staked ETH even as a collateral asset on other chains, but also on Ethereum. And I think we do plan on integrating it as a collateral asset on Ethereum when we can get the oracles fully set up and working for that. And I think the primary reason why that is useful on both Ethereum and other chains is that it's a yield-bearing asset, and so therefore, unlike most collateral assets, it actually generates yields for the borrowers who deposit this as a collateral asset, and so therefore minimizes opportunity costs, which is quite valuable considering that sometimes the LVRs are quite low on some of these. It's definitely very valuable. So yeah, we definitely would be interested in integrating it in our multi-chain deployments of Fringe, especially given it's a liquid asset, and often on these chains, there aren't as many liquid assets as there are on Ethereum because the ecosystems are a lot less developed. And that definitely makes sense. Yep.
Cool. Yeah, and I guess I'd like to mention that anywhere that wrap staked ETH is deployed or any of the ST assets, LDO will also be bridgeable, usable, and emitted as incentives. So that might also be an avenue for us. And I guess related to the bridging aspect, Lido has a policy of only really supporting canonical bridges. We see bridges as another extremely attractive target for exploiters. We've seen that just as much as we've seen exploits of money markets and lending protocols over the last, call it a year. So we work very, very closely with the layer 1 or layer 2 or sidechain foundation, stewarding organization, whatever the case is, to make sure that bridging is done in a safe way that's, takes into account some of the idiosyncrasies of the ST assets, while also making sure that the UI is just the same. The experience for a user using the bridges is just the same as any other user of a canonical bridge.
Justin, there was a question that I've been meaning to ask you, and it's about, Lido. And I just see, I don't know if this information is still like up to date, but I see that you guys are one of the biggest, if not the biggest, staker providers currently. How did you guys get there? Like, what was the growth strategy that you put in place to achieve this? Are you still like representing somewhat like 30% of the staked ETH in the Beacon chain?
That's correct, yeah. And, Lido has grown far faster and larger than I think the team originally envisioned that it would be. And especially on the Ethereum ecosystem, that is because of the inability to withdraw from the Beacon chain, right? That's one of the, I guess you'd call it, killer apps about Lido, is that, or one of the things that makes Lido a killer app on Ethereum, is that if you want to stake individually or with a custodial staking provider like a Kraken, for example, or one of the centralized exchange staking services, you have no publicly announced timeline for being to unstake. Even once the merge goes live, we will then be waiting for the Shanghai hard fork for withdrawals to be enabled. And at that time, we don't really know what the parameters for withdrawals will be. It could be as little as a 3-day waiting period. It could be a month. We don't really know. There could be significant competition, gas competition, to get your ETH unstaked in an earlier tranche. So what Lido's and other liquid staking services allow you to do is, if you do need to exit your position of staked ETH, you can use our pretty deep liquidity available on, Ethereum mainnet and on Curve, on Balancer, what have you, to exit with very little to no loss, right, at any time. So it gives you that optionality. In addition to that, we do incentivize actions to provide liquidity, things like that. So there's a lot of economic incentive to engage with Lido and DeFi strategies. And then lastly, Lido amongst DeFi has kind of proven itself to be one of the safest protocols that you can engage with. We've never experienced an exploit of any kind on any of the contracts that we've deployed. We've had no significant slashing events on any of the nodes that are operated by validators that participate in the Lido validator set. Part of that is because we also had to have a whitelisting process for bringing new validators into our validator set. All of the validators that we bring on are sort of the best in the business, the most professional, large-scale validating organizations like P2P.org, which is the team that sort of incubated Lido, and just a whole slew of other ones you can kind of view on our website, but they all do a phenomenal job. And their professionalism has also allowed us to be able to take in a great deal of capacity of ETH when the market demands it, which is something that other liquid staking providers like Rocket Pool have struggled to make possible. Though Rocket Pool is working on really exciting new updates that would expand their ability to scale the nodes that they're operating much more quickly.
Yeah, that's great. It sounds like you guys have an eye on robustness and
Yeah, I
And
think
people really only know and appreciate that when there's nothing to see here. There's no dumpster fire. And so that's great.
yeah, that's certainly true. And you know, for better or worse, Lido has gotten large enough and so well integrated into the DeFi ecosystem on many layer one chains that when something does go wrong, we're adjacent to it in many ways. We feel that that's because we're such an attractive asset to use in DeFi strategies, and not because of anything that we've done to encourage bad actors or unsafe practices within DeFi.
I'm
Yes.
curious about
Okay.
one thing, Justin, and it's what I don't know if you guys have put out any communications about this, but like, what is it that changes in your general strategy as the merge happens? What are you planning to do once that's completely once all said and done when it comes to the merge?
Yeah, I wouldn't necessarily be the best closest person to that, but what I can tell you is that our overall focus is to ensure the stability and safety of our platform and our users' assets going through the merge. Obviously, if something, some kind of negative event happens during the merge, we all have much larger issues than maybe even Lido working, but all of our effort is going towards that. We've already started shipping merge ready protocol updates as information comes out from the Ethereum Foundation on the form and shape of things to come. We kind of spend most of our development capacity proactively pursuing fixes that kind of come out of that guidance. Coming out of the merge, nothing will fundamentally change until, I think, as I mentioned before, the Shanghai hard fork and withdrawals are enabled. And then we anticipate seeing not just within Lido, but all kind of staking services, a whole lot of turnover activity as people who have been staked on the Beacon chain for quite a time are now able to redeem their positions and or rebalance their portfolios, whatever the case is for them as individuals. I think also we'll see probably more of an rebalancing event in terms of the weighting of which staking providers, what have you, kind of have what percentage of the ETH staked on what will then be the ETH2 chain. Just once in withdrawals are enabled, the markets can rebalance based on how they see fit, which is not the case at the moment.
Sorry, I was trying to myself here. No, really interesting stuff, and I mean, it was interesting to see how the model pan out with the Terra crash, for example, when that kind of thing could have been like a fundamental threat. But I think it was handled pretty well. And so someone was asking me to ask you guys, how does the UST Luna pegging mechanism has nothing to do with ETH, ST ETH? So yeah, because there was a scare about a depegging when it comes to ST ETH. So I was just curious if you wanted to explain how does the peg work and what are the mechanisms in place to maintain it?
Sure. So fundamentally, I think using the terminology of a peg is not correct, and it's partially on us for having adopted that language earlier on when we were a little bit smaller. ST-ETH is not a pegged asset to ETH. It is a correlated asset. Based on the overall market conditions at any given time, the market should price ST-ETH lower or higher than ETH in some kind of relatively tight band. Currently, I believe it's trading at a 2.25% discount, but during the sort of worst of the Terra collapse contagion, as some people call it, I think ST traded at up to a 7.5% discount to ETH. And that is because basically the deep liquidity pools that we had been able to support for STETH were working as advertised, and were allowing users to exit their STETH positions if they felt that market conditions were going to get worse, which is not something you'd be able to do if you had locked your ETH into a custodial staking service or a non-liquid staking service, right? Then you would simply be stuck and you'd be waiting. So in many ways, STETH worked as advertised. The demand for selling STETH into ETH as people sort of panic sold into the market or were forced to sell due to liquidations on DeFi strategies that maybe they didn't manage their liquidation levels quickly enough. Or, for example, teams like Celsius or 3AC were using the liquidity pool to sell STETH into to exit their positions quickly. So again, it sort of worked as advertised. Our main way of combating that is to ensure that there's enough liquidity up until withdrawals are enabled, at which point a user will just withdraw their ETH from their STETH position and then trade that into the much larger ETH liquidity pool. But yeah, as a correlated asset, there are good cases to be made for STETH trading below ETH at a time when the general market is risk off, and trading above ETH when the general market is risk on. That being because of the slightly increased smart contract risk, I suppose, or other risk associated with a derivative token, but also pricing in the annual yield that you receive from holding the token, which is about 3.5%. So right now, if you factor in maybe 1 year of holding STETH, you're looking to make up any discount that you would that's currently existing in the exchange rate. In a risk-on situation in a full bull market, there's much more advantage to using STETH in your DeFi activities. And certainly we think after the merge, there'll be even more incentive as the yields could triple or quadruple depending on network activity or how everything shakes out after the merge.
All right, great. Brian, anything you want to add there, Alex?
No, I think I'm good. I think you're intending to open the floor up now for any questions that people might have or comments that they may have.
Exactly. So if you guys are listening to this and want to come in and ask a question, this is the time for you to do that. Just request to speak and you'll be brought up to the stage. Really appreciate most of you sticking for the whole length of this thing. So yeah, just request to speak and you'll be brought up here. Also, I'm looking at the Fringe Finance chat to see if anyone wants to ask any questions in there in writing. That's of course also allowed. I'll check the questions and read any that you ask. Justin, are there any further comments you want to make or any questions your community may have right now while we wait for people to request to speak?
I don't have any, but I'm very, very happy to answer any additional questions. I know that I've dominated in asking the questions so far in this conversation, so thanks for bearing with
me. I love when people come and do my job for me, man. No, thank you very much for taking an active interest in Fringe and also reading our monthly statement that we put out yesterday. It's just a very exciting time for us in Fringe to be thinking about so many moving parts right now, all of them with a vision to continue building utility for users, while also we have a bigger chance right now to just be interacting with DAOs and putting out proposals. One question is for you. What are the challenges that you have seen as a DAO, and what are what are the roadblocks that you were anticipating, or the positive things that you weren't and that came out to reality?
Well, operating as a DAO is quite difficult, and it only gets more difficult as you scale up. We are all working in an environment as DAOs where decisions need to not just get buy-in internally, but we also need to ensure that our community feels comfortable with the decisions that we're proposing, that they feel that they can propose new courses of action. We are beholden to the decisions that they make. One of the really interesting conversations that's been going on in the Lido forums right now is this conversation around moving towards a dual token governance structure, one that would allow holders of ST assets to participate in government as well as LDO holders, though not necessarily in the exact same ways. I definitely encourage everybody to have a look at that. If you want to navigate over to our research forum, it's linked on the website. That is a really, really fascinating conversation and interesting proposal, because it's not something that we've seen, I think, in any other DAO of our size. But we do feel that holders of ST assets are really significant stakeholders in the future of Lido, and that they should have a voice. This is sort of all part of our philosophy as a DAO of decentralized decision making and being as closely aligned to the ideology and philosophy behind, Ethereum and all of these other layer one chains, but especially Ethereum, I think, of we get security and better action through this kind of community governance. Though, of course, it does create many roadblocks. It's very difficult to make quick decisions as a DAO when everything has to go through a governance process. These are just the trade-offs that we make. And again, the larger you get, and then the larger the distribution or better distributed your governance token is, the more difficult it is to do things like reach quorum on snapshot votes, or even reach the holders in order to inform them that a vote is happening of importance. We definitely see, like many DAOs do, a lot of issues with voter apathy, or even, for example, a large LDO holder might use a platform like Fringe Finance to get value out of their LDO holdings, but as they do that, they lose the optionality to participate in DAO governance if they're submitting LDO as collateral. So this is sort of the mess that we're operating within.
That's really interesting because... Go ahead, Brian.
Yeah, I must say you're quite brave there, Justin, because on the face of it, those two different, or it would pose certain challenges, I would imagine, because those two personas, which are the customers, like the staked ETH holders, and the governance token holders, the Lido token holders, they may have opposing imperatives. For example, the staked ETH holders will want to pay, for example, or will wish to pay less fees, yet the governance token holders will wish to impose higher fees on the platform. So things like that, I imagine, will be challenges to get through.
Yeah, and like I said, it's not a direct dual token governance structure that's been proposed. It's, I believe, and I'm probably bastardizing this a little bit, the whole proposal is quite long, and there's been a lot of discussion around it over the past, I think it's been live since June 10th, so almost a month. What this would allow is STETH holders to apply a veto to a decision that the LDO holders have made if they reach a certain threshold or quorum, right? This is basically sort of a circuit breaker, I think, that some people feel is important to ensure that Lido as a DAO is aligned with Ethereum as a whole and continues to act as a good partner to the Ethereum community and remains aligned in the long term. So it would prevent, for example, LDO holders from making decisions that would, negatively affect the general, much larger set of SDETH holders or users.
I also wanted to say, your dynamics such as the ones you're planning on introducing or the ones that this proposal mentions, I think really bring up the fact that this ecosystem is quite young and that everyone's sort of like trying to bootstrap their own DAOs and their own systems, and we're all sort of doing the same and following the same guidelines. But in reality, there is no end to how diverse things can get. And I think with time, we're just gonna see like every ecosystem governing itself in very diverse ways and just like contributing to making the most for what their actual use cases demand. So I think that's pretty cool.
Yeah, we're all, another thing about DAOs is that we're all sort of building the train tracks as we drive the train.
Exactly.
We're doing the best that we can given the best practice that we see available to us at any given time. You see that with things like DAO governance, but also sort of DAO operational structure. When we first launched as a DAO, it was over a year and a half ago, and the best practices for organizing a DAO, the DAO tooling landscape was very, very different. And as I said before, the governance process makes it very much more challenging to enact change than you'd see in a normal corporation of a similar size, which has, executive function and executive management capabilities that we don't have. And it's such a rapidly changing space. So a year and a half further down the road, there's a great deal of operational upgrades that we're working on internally to get us up to the speed that newer DAOs are able to operate on. But it's always a challenge.
Yeah. There's a question on our chat for you, Justin. Are there plans for LDO to do a multi-token distribution when staking goes live? I don't know how relevant this question is, but up to you.
I'm not exactly certain what's meant by multi-token distribution.
Yeah, me neither. Let me try. I was hoping that you did. Well, this was one question that came on the chat for you. Reminder: we have 3 minutes left on the spaces, so if anyone wants to jump to the stage and say something, this is your moment. I remember Medivishi was requesting to speak for like most of the spaces, and now you're shy, sir. So please consider jumping to the stage to say something.
Come on up.
Brian, Alex, is there anything you want to add?
Nothing here. I've gone on long enough, I think.
By the way,
Carlos?
for the guys in the fringe finance community, Brian is just using his brand new Twitter account, so go and give him a follow. Also, Alex here. All right, people are asking people are saying just that they feel very bullish about these spaces and after it, so that's pretty cool. Are there any further ways in which Fringe and Lido can collaborate and integrate each other? I think that's a good one for Brian.
Nothing comes to mind at the moment, but that does not mean that there is nothing necessarily. I think I'd need to have a chat to the Lido team a little more closely because, there's so many opportunities out here, and it sounds like you guys have got an eye on solid engineering, and we're interested in talking to anyone about ideas that could arise from that. So, in short, nothing comes to mind immediately, but this is an evolving space. So who knows, Carlos? Who knows?
I think one avenue for the integration that we definitely want to pursue is listing wrapped staked ETH, which we currently don't list, but we are in the process of figuring out how to list, and that would be very, very valuable.
Yeah, I think we have a bit of a roadmap. We certainly have wrapped staked ETH. I think we also have ST-Matic on Ethereum mainnet, which might be something to pursue once you all are live on Polygon. And like I said before, Lido is pushing very hard to expand the Lido ecosystem to layer 2 networks like Arbitrum and Optimism, and we can certainly look towards doing integrations there. And then once we have basic integrations done, I'm sure there are really cool new products that we can build. I don't know how you all are planning on building your fixed rate products, but we do have a number of partner teams that are building or have built fixed rate products based on the yield generated by ST ETH. And that's, something that you might be able to consider.
All right. Well, I think we can call these spaces to an end now. Thank you very much for doing this, Justin. It's been a pleasure to talk to you, man.
My
And
pleasure
also
too.
to everyone in the Lido team that helped put this together, to Brian and Alex, because they're doing this at their 3 a.m. currently. So we'll just, we'll just give you a chance to rest, guys.
Yeah.
Thank you very much to everyone that joined, and we'll be publishing the recording of these spaces on YouTube pretty soon. So stay tuned to that.
Great.
Bye, everybody.
Thanks, Justin, for coming, and thanks everyone else for listening in. See you.
Yeah, that's great. Thanks, guys.
Thank you very much, and we'll keep watching this account because there's a lot coming. Thank you very much, and we'll see you soon.